Brandon Lehman here. I want to talk today about retail real estate. We're going to talk about four main classes. There's many more than that, but we'll dive into at least those four popular ones and where the opportunity lies. At West Hive Capital, we invest in revitalizing neighborhood retail centers. So we love retail. We love everything about retail. We don't focus on anything else. Right now, I feel like retail is quietly having a massive comeback. Everyone's talking about multifamily, industrial, but retail is where we think best opportunity in commercial real estate is right now. Let's talk about the four CRE asset classes. Multifamily, popular, it's a very crowded space. It's also highly regulated. This is where people live, where they sleep, it's their livelihood. You have things like rent control. It's easy to get into. You can get into a multifamily property, 2 units or more. I mean, you could house hack and technically get into a multifamily property. I think that's why it's super popular. It's easy to get into. It's a low barrier of entry. And you have anything from, an individual all the way through a private equity firm, massive commercial real estate firms that will get into the multifamily space. So it's broad. Everyone needs a place to live. Here in Southern California and California in general, there's a housing shortage. And so you can see why it's a popular sale. Industrial, it's hot, but I agree. I would say it is overheated and it's institutional heavy. Think of how large industrial properties are. It's got big tenants in there with Amazons and all the e-commerce brands. So you need a big chunk of land. You need massive capital outlay to build an industrial building. It's a little harder, very high barrier of entry, I'd say, and you have a lot of institutional heavy type people in there. They're getting long-term corporate leases. It's a little safer for them. Let's talk about office. Distressed. It's been in a little bit of flux since COVID, with the whole work from home and, people not coming back to the office, which has actually even hurt retail. When you have the central business districts, nobody's at the office now. Well, no one's going out to lunch. No one's going out to eat. No one's, kind of doing the drive to work and stopping at their neighborhood restaurants or coffee shops. So it hurt the retail sector post-pandemic. Absolutely. And then let's talk about retail. So we've talked about multifamily, industrial, office, and now retail. We believe it's misunderstood, but it is evolving. We have cap rate compression across the board. What happens with that is we have low vacancy. We have not been building retail for the better part of more than a decade. Since the Great Recession, we have not built a lot of new retail. There are exceptions to that. There are other markets where retail is being built. Let's think Phoenix, let's think Inland Empire. Your typical investor in retail, it can be mom and pop and it can be institutional. So there's a barrier of entry, absolutely, but there is a better risk profile, I would say. So when people think of commercial real estate investing, they usually default to multifamily, maybe industrial. But today, I want to break down 4 major asset classes and show you why one of them is completely misunderstood and full of opportunity. Let's dive deep into multifamily. The crowd favorite, but it's getting squeezed. Still the most popular among syndicators, smaller investors. Touched on that where you can get a 2-unit all the way up to 200 units. So you can kind of see the broad range of investment that could come out of that. Why did it take off? Everyone needs housing. It's tangible. You can put Freddie, and Fannie Mae debt on it, which made it extremely accessible for people. But what's the problem? It's overcrowded. Cap rates are extremely compressed. You have regulations in some of the bigger cities with rent control, eviction moratoriums that just continue to grow. These are sometimes just kill the landlord. The landlord's the bad guy. And because of this, investor returns are shrinking as acquisition prices climb. Turnover's constant too. In multifamily, tenants leave every 9 to 12 months. Rents can stagnate. It's really a volume game. And lately the margins are just not what they used to be. Let's dive into industrial, the darling of the last 10 years. It's been super hot since e-commerce exploded, fulfillment centers, warehouses, logistics. The reason institutional guys like it, you think of long-term leases with solid tenants like Amazon, FedEx, UPS, a lot of these 3PLs following the e-commerce boom. But now big REITs, pension funds, and private equity really dominate the space. So for a smaller private investor, it's going to be hard to break into that. Hard to compete, and deals are massive. You're talking 100,000 to 1 million square feet. Hard to find the land for that, hard to get that entitled, also expensive to do so. Because it's a safe investment, cap rates are extremely compressed, even lower than multifamily in a lot of markets. Big corporate-backed leases makes it a little bit safer. So summary, barrier to entry is extremely high for mid-sized to small investors. Let's talk about office. The uncertain bet. we'll call it. Post-COVID, the office is really still figuring itself out. Here we are in Southern California. I was at a recent real estate kind of state of the market talking about downtown Los Angeles, and it just hasn't come back. There are suburban office that has come back, places like El Segundo in Southern California here, where people are starting to move away from the downtown districts, whether it's safety, people just don't want to travel. Companies are absolutely downsizing central business districts. Hybrid work seems to be the norm. Vacancy rates in some markets are over 20%. We haven't seen stuff like that in the office sector maybe since the Great Recession. Lenders are still very skeptical of this. Deals are risky unless you're doing a heavy reposition or you're bringing something a little bit different, super amenity heavy, it's in the right area, it's in a place where people want to go. For most investors though, I'd say it's too volatile and unpredictable right now. Retail, calling it the misunderstood asset class. Retail got hit with the retail is dead narrative for years, but it's not true. It's bad retail that died. Think malls, think big boxes, etc. Some of those that the e-commerce did take out. You see a lot of malls, that's the headlines, and so you're wiping out retail. Some of those malls are 1 million square foot, and so you can understand why that makes the headlines. As soon as we close a mall or someone's going to redevelop or reimagine, or maybe they're bulldozing it and putting up apartments because we do need housing and things. So this is where retail is getting a bad reputation. You only read in the headlines, think of all these big tenants that continue to go out, big lots and 99-cent store, and just people taking out massive square footages that have just now gone to the wayside. But what is booming? Necessity-based retail, service-based tenants, things you can't buy online. Therefore, neighborhood strip centers. People want convenience. These places are booming. They want quick in and out. We'll call it convenience-based retail, necessity-based retail, Amazon-resistant retail. These are the types of centers that are booming. They want to go out to eat. They want to meet with their friends. They want to pick up that cup of coffee. Some of that stuff you just can't do online. So these are the ones that are doing it. Really, retail is largely ignored by the average investor, which equals opportunity in my eyes. You can buy at better pricing, you can create value with smart leasing, and lock in long-term leases where tenant pays the operating cost. I don't know if you're familiar with a triple net. Tenants will often pay taxes, insurance, maintenance, property management, you name it, and on top of that, your normal rent. So just because something is trendy doesn't mean it's the best investment. Multifamily might be popular, industrial might be hot, but retail has the fundamentals, the stability, and most importantly, the upside. And that's why we focus on it. Let's talk about the case for retail. So we've talked about the big 4 asset classes. Now let me show you why retail deserves a serious look and why it's the focus of everything we're building. Retail leases are long-term. Tenants pay taxes, insurance, maintenance. Think triple net. It's more predictable cash flow. Retail centers are undervalued because of the outdated e-commerce fears. Essential retail like medical, food, service-based, Amazon-resistant tenants are booming. Vacancy is at its lowest since 2007, I've recently read. But investor demand is still catching up. Hopefully the next decade here of a retail wave. Has strong leasing fundamentals for a good, well-located center without the regulations of multifamily too. We don't have rent control. It's the free market. We're doing business to business. We're signing long-term leases. Whether they're mom and pop, this is their livelihood. A lot of people will ask about that. If you don't put these credit tenants in there, how do you know that these companies are viable? Well, to ideally 70%, maybe 50 to 70% of some type of corporate backing of a tenant, over a few hundred million plus. But the mom and pop, this is their livelihood. They're serious about this. If this is only 1, 2, 3 locations for them, and they're kind of what we call like a sticky tenant in the neighborhood really knows them. They got a big following. That is their livelihood. They're staying there all night. They're the ones doing the books. There's nothing wrong with that. That is the corporate guarantee that we like to see, the hard work and the effort being put into that. Retail centers are business ecosystems. A smart mix of tenants can literally double the value. And an easy value add wins are just signage, parking lot, a facade remodel, and reposition the tenant. Get rid of non-performing tenants, put in a good mix. It's part art, part science. No matter what the performance says and what the numbers are saying, there is still an art to kind of putting the perfect tenant tenant mix together, making sure that they, really blend with each other. People are coming to do more than one thing at the center. You want to drive that foot traffic. Let's talk a little bit about the triple net type of a lease compared to a multifamily property where the owner really pays everything. Think repairs, utilities, taxes, any capital expenditures, of course. You're constantly reinvesting just to maintain margins or bump the rents, where in retail, your triple net lease, your job really just becomes an asset manager. You're not babysitting the property. This structure alone really changes the entire game. It lets you plan for cash flow without the unpredictability of monthly swings. Why do we think retail centers are undervalued? And I like to think of just lazy headlines. We got a bad reputation after the retail apocalypse headlines a few years ago, but it's really just the wrong story. Malls, of course, yeah, they got hit. Department stores, yes, still happening to this day. But that's not what we're talking about here. That's not what we're buying. We're buying neighborhood centers. Think Starbucks, think your local dentist, a dry cleaner, a gym, a restaurant. This is where the real opportunity is lying. The market still treats many of these centers as risky, so you can buy them at higher cap rates, typically with less competition here. Essential retail is booming. People don't stop going to the dentist, they're grabbing takeout or dropping off dry clean just because Amazon exists. Service-based, experience-based, and medical tenants are dominating the retail right now. These are tenants who just can't be replaced by the e-commerce, and they're looking for space in the exact centers that we're trying to acquire or helping teach people acquire. So why is the vacancy rate for retail properties the lowest since, say, 2012, but pricing hasn't just caught up? Retail vacancies across the U.S. right now are hovering around 5%, and that's really the lowest since the great financial crisis. That's because construction for new retail really slowed down over the last decade. They've gotten rid of bad retail, but not building new retail. And so we have a supply and demand imbalance. Really, people just haven't caught on. They're listening to the headlines, and the investor pricing just hasn't caught up yet. It's kind of a rare moment in real estate when demand is up and supply is tight. They teach you in real estate school, you start getting below that 5% vacancy rate, it's actually time to start building. It's hard to build new retail, especially in an urban market or places that are semi-landlocked. What we're doing is taking existing centers and repositioning them, whether that's even taking down square footage to add an outdoor experience or add, kind of that patio, a little bit more community feel, places that typically you see a strip center that's just kind of in and out, trying to create an atmosphere of people that want to come and kind of hang out at these places. And the strong fundamentals I touched on, you get a lot of multifamilies dealing with the rent control, eviction moratorium, and government interference, a lot of negotiating going on with banks, and some of the mortgage payments on the back end of these loans can't get rid of bad tenants, and so it really messes with the landlord side of things. In retail, we don't have any of that. These are commercial contracts negotiated between professionals without state-imposed limitations. It is the free market. Depending on that location, depending on the supply and demand equation, you can typically outperform your performer rents. And when you want to raise rents on a retail lease, it's usually already baked into the agreement. So we put in what we call escalators. So it's all negotiable. But a typical escalator, maybe 5% every 5 years, maybe 3% a year is ideal, 2% a year, whatever's negotiable depending on who you're negotiating with and how good the brokers are. And there's no cap on it. There's no politician telling you what your return can be on these. I mentioned retail centers are like business ecosystems. A good retail center functions really like a little economic village. Every tenant supports one another. The mix as well, right? Think of your dentist, really needs Starbucks next door to him, the gym that drives traffic to the smoothie shop, or the restaurant that brings in the dinner crowd right after the med spa closes. So if you understand that, you can intentionally curate your tenant mix, increase the foot traffic, and drive cross-pollination and boost overall sales. And that means your tenants will stay longer and eventually pay more. And it really is an easy value add play. We don't get into a lot of the tenant improvement side of things, where in a multifamily, a tenant moves out, you've got to go in, do a major renovation, interior if you're bumping rents and whatnot, plus the exterior, plus all the common areas. In retail centers, we can have simple but yet impactful upgrades that dramatically improve the value. Think of just new signage, restriping or resurfacing the parking lot, kind of give it that nice new look, modernizing the facade. One thing we like to do is really raise up the sign bands on ones that have like big slope roofs that you see. where you get like big signage now, very visible from main thoroughbreds, improve the lighting, improve safety, kind of branding, and repositioning a couple of bad tenants. So you don't really need to spend millions just gutting these places and renovating them. There's just strategic surgical moves that'll create real equity in them. And multifamily value add, like I said, often means new countertops and all the appliances, and retail, lease negotiations, tenant mix, and increased visibility. So what people get wrong about retail? Let's talk about what most people still get completely wrong about retail real estate, and why that misunderstanding is exactly what makes it such a great place to invest right now. Most investors just don't understand how to operate retail. Retail isn't like buying an apartment building and just raising the rent. It's not about buying real estate. It's really about operating kind of a business ecosystem. I mentioned it's part art, part science. Success really comes from understanding the leasing, the tenant behavior, and traffic drivers. A little tidbit I've learned in the last decade is, what side of the street are you on? Are you on the going home, the going to work side of the street? That could determine who you put in there. Coffee on the going to work side of the street, maybe dinner on the going home side of the street, and dry cleaner, on the going home, they pick it up on their way home, kind of thing. So most indicators just don't come from a leasing background like that, and they don't know how to run a center the right way. So retail isn't hard, it's just different. And because so few people understand how to operate it, there's less competition, and therefore more upside. Retail does get a bad rap for being management heavy, and it can be if you don't know what you're doing. But when you have the right leasing brokers, the right property managers, vendor relationships, retail can actually be extremely passive and extremely hands-off. If you negotiate those leases properly, put in good tenants and a good mix, it can actually be a more passive investment than apartment building, office building, etc. And we structure deals to be passive for investors. We'll handle all that complexity of setting it up right. A lot of retail tenants are not just tech startups, right? They stick around. I mentioned before, think of multifamily tenants might leave every 12 months, but retail tenants, they typically will sign 10-year leases plus a couple of 5-year options. Once they're a staple in that community, they don't want to leave. They've gotten their base. They know they're successful. If anything, they're trying to duplicate that in other areas that mirror that demographic or that type of a client that they're looking for. They build out their own space too. So they actually put capital intensive. They invest in their own location. They have to train their staff, build up their customer base. That's why retail tenants don't want to move unless they're really forced to. And that's why you still see some that are operating in really rundown centers. And it's just doing them, more harm than good, but they're operating because they know that they're making money still, and they actually do have a good tenant base. So what does this mean for us? That means we've got stable income, we have less turnover, higher renewal probability as well. As long as you upkeep the center, you invest as a landlord into the center, common area improvements, and keep getting that tenant right mix. But retail's biggest problem really isn't performance, it's just perception. And when you understand that, you see what an incredible opportunity that others are missing here. Why retail wins right now. So let's talk about timing and why retail is uniquely positioned to win right now, and why we're seeing more upside in the space than we have seen in years. Let's talk about the post-COVID consumer behavior shift, and what I'm going to say, the retail rebound, because we have seen quite a drive for retail after COVID. COVID really pushed people online, so it created a deep craving for in-person experiences. People were missing out. People want to get out. They want to eat. They want to work out. They want to socialize. They want to do things locally, and retail is at the center of all of that. It is a place for gathering. In fact, service-based retail like gyms, some nail salons, med spas, and restaurants have seen a massive comeback over the last 4 or 5 years. And this isn't speculative. This is what people are doing right now. In summary, retail did not die. It did need to adapt. Just like the businesses that survived COVID, now they're thriving if they made it through all that. Even e-commerce brands are going physical. It's not just legacy retail that's doing this. Many e-commerce brands are now opening brick and mortar locations. They've understood that customer experience place, maybe they can just go and touch and feel the items, actually see them in person. So they have become even showrooms of some sort. You can try on different things. You may not be able to buy it there because the store format is smaller than typically before. But they're saving on overhead. You can go get it online. They can stock it in a warehouse somewhere. And so we've seen a lot of that stuff. Warby Parker, Allbirds, Amazon Go's. These are all operating physical stores right now. Let's talk about the lack of new retail supply, which is equating to a low vacancy. It's just a supply and demand equation. There's been very little retail development over the last 10 to 15 years, and meanwhile, tenant demand is up, especially from those service-based business. So we're not fighting for tenants. They're actually fighting for the space right now. If it's a good location in a nicely redone center, the tenants are knocking at the door. And institutional capital hasn't fully returned to retail. There's a lot more money 2024, 2025, where I can tell it has returned to retail or they're interested in it because they're starting to catch up. But multifamily industrial are still flooded with institutional capital. There's still, people just don't understand retail and they're still just going to things that they know. And that's okay. You want to invest in things that you know. And retail is just still not the darling of Wall Street yet. Pricing is still attractive, cap rates are higher, and competition is lower. Because when institutional capital starts pouring back into retail, and it will, today's pricing will look like a steal. So a question we get a lot is, how do we analyze a retail deal? Let's talk about how we actually evaluate retail centers, what we look for, what we try to avoid, and how we decide if the deal is worth moving forward on. One thing I love to start with is the story behind the property. Really, every property has one. I love to hear, why is this for sale? Who's the current tenant mix in there? Is there distress, mismanagement? Where's the opportunity lie? There's always a story behind the scenes with the seller. Maybe they were mismanaging it, therefore it became a headache. Maybe they've just let the center fall, die on the vine, and they're not reinvesting into the center, not reinvesting in their tenants, and so they're losing tenants because of this. And so we're looking for those type of centers that have a great story behind them. They're underperforming, not necessarily because of the location, but just because of poor execution. So you really can't underwrite a retail property on a spreadsheet alone. It's part art, it's part science. You need to understand the business story on the ground, really. Location analysis. Is this corner worth owning? Visibility. Is a center on a signalized intersection? Looking at ingress, egress. Can you see it from the street, or is it kind of tucked behind stuff? Is it easy for people to get in, access, parking? I'm not a big fan of two-story retail. People are good. The two-story tenants seem to never do as well. Is there enough parking? Parking kills a lot of details, especially in heavier populated areas. Parking is a huge problem. We want to look at traffic counts. What's the daily car count on the adjacent road? Do we have the population growth and the car count to justify this? And demographics. What is the surrounding area like? What's the income profile? Who lives in the area? What does the consumer spending look like? What are they spending stuff on? Even down to the age, what type of people are living around the area? As you can fix a lot of bad things about the property, but you really can't fix a bad location. We want to dive into the current tenant mix and also put a vision forward about who we think the good tenant mix would be. We break down rent roll, we look at tenant categories, lease lengths, and rollover risk. So we want to see a balance between daily tenants, coffee, food, medical, and destination tenants. People that will travel to go to the fitness studio, a salon, or a good restaurant. And we ask, are they national, regional, or mom and pop? Do they drive traffic? These are all questions that we're kind of checking off internally. We really like to get into stuff that we can turn over tenant spaces fairly quickly in the near term, think 1, 2 to 3 years. So we're looking for tenants that are month to month, have lease terms expiring, and any spaces that could be dark but are still paying rent. We want to go back, try to negotiate with this. Something that can really help is a good anchor, can really stabilize a property, but a bad tenant mix can kill it, even if the center looks good on paper. Next up is financials. How does it perform today and what could it do? We go in and look at in-place NOI, current rents versus market rents, and overall operating expenses. Can we add some efficiency there? We're buying more distressed retail, thinking 50% vacant plus, value add is really 70% occupied. Some of the in-place NOI isn't as important to us, but is absolutely something is you're going in at the price. Some people are asking, the bid-ask gap is off, and so we want to take in consideration what people are paying right now, but we're also projecting out. We want to see that, on a 3-year business plan or a 5-year business plan, what can we get those market rents to? How can we lower operating expenses? And that's adding money into the property, doing capital expenditures, CapEx, improving the property so that there aren't these maintenance issues that are continue to go. So we're not necessarily just buying for cash flow, we're buying for that opportunity in the future, in the short-term future, right? We want to turn over these rents, improve the property, and ultimately get higher rents. So what happens when leases roll? Can we bring in better tenants, increase rents? We build a performer really based on the actual upside of the property and not necessarily assumptions. We're poking holes in this. We also factor in a lot of deferred maintenance. This is what I mentioned with putting the capital expenditures forward and tenant improvement obligations. If you want to get good tenants, you need to put some capital out as landlord to allow them to build out their spaces. You're investing into them for, say, in turn, a 10-year lease where we're really in this together. It's a symbiotic relationship. It's a little bit of a partnership going into this with your tenants. And then, is there a value add potential? Can we make this better and can we do it fast? We ask, what are the low cost, high impact ways to improve the center? And I mentioned this before, but examples are restriping or resurfacing the parking lot, updating the signage, painting or improving the facade, lighting, landscaping is huge, bringing in a stronger anchor tenant, someone that's going to drive foot traffic to the center, and then replacing the weak ones. A lot of those month-to-month ones, try to dig through some financials on that and see if it's something that, if they're going to be a good sticky tenant in the center. Example, like a liquor store. Sometimes those people don't like those in those centers, but they might have quite a following in the local neighborhood and therefore willing to pay pretty high rents for that. We always utilize the market and professionals in the market. We talk to tenants, we talk to brokers. What's the market saying? Before we go too deep, talk to leasing brokers in the market. What do they think of the center? What type of action do they get around there? What type of tenants do they know moving into that region? These guys are on the front lines. You want to see if you can be able to lease this thing. If you do go in and put a substantial amount of capital to improve the center, what do you think those rents can be realistically, right? Be conservative about this. Are tenants trying to get into this area? Or is this a place that everyone's kind of avoiding and therefore that might be why you're getting such a good deal on it? But we also check with local businesses too. There's a balance there of the corporate big hitting tenants versus the mom and pop local ones that we'll really like. Next thing is, how are we putting our capital stack together? How will this deal be funded? We're looking at purchase price, we're looking at renovation costs, we're looking at reserves and loan terms, and what is the equity that's going to be needed? Does this deal work at today's debt pricing? And can we sell or refinance later? We try to underwrite it with both of those scenarios. There always is a sale at year 3 or year 5. It's a 5-year business plan or a 3-year business plan or a 2-year, whatever that is. What does a sale look like? And then, is it possible to refinance? And some of that's out of our control when you talk about the debt markets, and it depends on what type of environment you're in. So an inflationary environment, some of that we can't predict, but we're running those scenarios during the initial underwriting. And how much risk are we taking on? What is the downside ratio if a tenant leaves? How much of this center could be vacant or not paying rent, and we could still make our debt service? And then what's the exit strategy? I mentioned there, if it's going to take 3 years to implement the value add strategy, is this going to be a long-term hold? Is it going to be a sell? Is it a refinance play? These are questions that we're asking ourselves and running multiple scenarios here. And we define that typically before we close so that everybody's aligned. We like to syndicate. We're talking about the deal. We need to be aligned with our investment partners' goals as well. If they are expecting a certain return on their investment in a shorter period of time, we need to take that in consideration. Nobody wants rogue investors or people that aren't aligned, with the business plan going in. So we try to build some flexible strategies, but we always go in with a clear plan. This is a little background on why we like retail and where we see the opportunity. In summary, I think retail's on the upswing right now. I think we've got a good run ahead of us here. It's gotten more competitive, absolutely, but I still don't see the amount of capital, the amount of interest in other investors chasing it. It looks complicated, right? You really actually think it's mostly a lot of big institutional players playing in it, but you'd be surprised that most small retail centers are owned by small mom and pop, small families that maybe bought these things 40, 50 years ago. And it is time for them to get out. They're retiring. They have retired. This is their nest egg. It's gotten transferred down to their children who have nothing to do with this, but they have let the center die. And so it has become a management nightmare. Those are the opportunities that we're looking for right now. And as an investor, comparing retail versus multifamily right now, I think retail doesn't lie. I mean, the numbers don't lie. We can get in at a good ingoing cap rate and do a major value add improvement. So hope you guys enjoyed a little bit of why retail here. Follow us for more information on what we do, how to raise capital, how to reposition a retail center, and look forward to talking some more.